One of the most common questions that we get when we're talking about the topic of portfolio performance and benchmarks is how did my portfolio perform relative to the S&P 500? One of the most common US stock market benchmarks that you'll see reported on. And it's a great question. One of the most important things we can do is pay attention to strategies and be tracking them to make sure that they're keeping up with expectations. The question we find ourselves asking is the S&P 500 the right benchmark for your specific portfolio situation? So in this discussion, we're going to take a quick deeper dive into the S&P 500, highlight a few things to know about it as a benchmark, and then 3 principles to figure out if it's the right benchmark for you. So in order to do some of that analysis, we are going to look at this analysis done by the team at City National Rockdale. They are a portfolio management and economic analyst team. And so they've given us some helpful feedback or a perspective here that we can use to evaluate this as a benchmark. But first, let's talk about what the S&P 500 is. So the 500 in its name essentially means it tracks 500 of the biggest companies in our economy. They span different industries, they span different types of companies, sizes of companies, and so on. But the thing to know about it is that it's what's called a capitalization weighted index, meaning the biggest companies carry the most weight. So that means, think about a swimming pool and rocks surrounding it. If you had 500 rocks surrounding it, some of these big companies, Apple, Microsoft, Amazon, they're like giant boulders. If you throw a giant boulder into the swimming pool, water is going to spill out over the side. It's going to make a massive splash. If you throw a tiny pebble, one of the smallest companies, into that pool, it's barely going to make a ripple. You're barely going to notice it. So this is one of the things that this analysis helps us to see. The S&P 500, though it tracks 500 companies, the top 7, Apple, Microsoft, Amazon, Nvidia, Google, Meta, or Facebook, and Tesla, those 7 companies, when you add them up size-wise, they make up 28% of the S&P 500. So when those companies move, they influence the S&P 500 significantly. The other 493 companies make up about 72% of the index. So what does that mean? Well, those 7 companies, how they perform are really going to shape what the S&P 500 and for a lot of people, their perception of the US stock market, how that performed in any given year. So the assessment here helps us see something really valuable. In 2022 and 2023, how did the S&P 500 perform? Well, in 2022, it was down about 18%. And then it turned around and rebounded in 2023 by 26%. So when you look at it point to point, it was about even. You came ahead a little bit. If you removed those 7 companies, you still are tracking 493 companies. If you remove the 7 biggest companies over here, in 2022, you were only down 7%, and in 2023, then you were only up 10%. So even though those are the majority of the same companies in the same index, those look like dramatically different years and maybe even dramatically different portfolios. If you took all 500 companies and said each of you gets equal weight in terms of performance for the S&P 500, in 2022, you were only down 11% and up 14% in 2023. So what that indicates to us is these 7 companies carry a massive amount of weight. So you put $100,000 in the S&P 500. One thing that not a lot of people recognize is I'm really putting about 28,000 of those dollars, a little less than that, but about $28,000 into these 7 companies. And then I'm putting the other about $72,000 into 493 other companies. So that can help us to decide, is that the right benchmark for you particularly as an investor? So a couple things that we would tend to think about: what type of an investor are you? Do you like a lot of risk or do you not like a lot of risk? If you are very aggressive, then this could be an appropriate benchmark for you. If you're retired, you're looking to reduce volatility, this may not be even close to the right benchmark for you. So there's a couple of principles we can take away from this in terms of evaluating the right benchmark for your portfolio. Number one, as advisors, we would always say you should let your needs guide your strategy. What that means is setting up the objectives I want to accomplish, figuring out how much risk I can personally tolerate, and then figuring out how long I have until these goals. If I'm a very aggressive investor and interested in being very weighted towards tech companies and growth companies, a portfolio that's similar to the S&P 500 could be a right fit. But if you're retired and you're trying to draw stable income from your investments, you might need a completely different portfolio, one that prefers dividend-paying stocks and has a significant allocation to bonds, for example. So your needs should guide the strategy you select. Then, based on the strategy you select, we get to principle number two, which is we should be evaluating your portfolio against the appropriate benchmark or mix of benchmarks. If you're half in stocks and half in bonds, you shouldn't be measuring your portfolio against an index like the S&P 500 alone. That's 100% in stocks. If you have stocks that are spread across the globe, some in the US and some internationally, you also will want to take that into account. So you want to look at your strategy you've selected based on your plan, and then evaluate that based on an appropriate benchmark. And then we want to eliminate the guesswork. It's often tempting to look and say, oh, well, these couple of companies have really rallied, therefore I should put a lot more into them. There's no saying that's going to continue. And in fact, if you look at the second chart that is in the linked article, you'll see that no single asset class outperforms every single year. They kind of jockey for position. And so having a strategy that blends these together and then fits your objectives that you can stick with over time and adjust based on your needs changing, that history shows us that's a really reliable way to build your strategies. So one thing that we always want to highlight is that when you're working with a team like us here at Alterra, one of our roles as financial advisors and wealth managers is to have these conversations. It's to help establish objectives, choose strategies, evaluate those strategies over time alongside our clients, and make sure we're providing valuable information as to what we expect, what's happening, and how we should be deciding if we should make any changes. And then again, adapting those strategies to plans as they change over time. So you're welcome to send any questions if this brings those up. If you're looking for an approach like that in your own planning, you're welcome to click the link at the bottom of this article and reach out for a further conversation with our team. But until then, we hope this has been helpful.